Okay, is the mic on? Are we good? All right, let's get started. Welcome back, everybody. So we'll begin. We're really pleased, Catherine, Joshua, Avi, and I, to welcome Tiff Macklem to make the opening remarks today. Tiff, of course, is the Governor of the Bank of Canada. And for our American guests, that's the equivalent to the Chairman of the Fed. And Tiff is an economist. He's an alum of, some of you have been to conferences that we've had at Queen's. He's an alum of Queen's and Western. He's worked on a number of very interesting assignments. I'll just describe three of them. He was Associate Deputy Minister in our Ministry of Finance during the financial crisis of 2008, 2009, and all of the unique economic issues associated with that. He played a very meaningful role in Canada during that time. Then he joined Dan Treffler and Christina, Joshua, Avi, and I at the Rotman School. He was our dean, and that was during the time where we were, as far as I know, we were the first business school in the world to host to convene a meeting on the economics of machine intelligence. So in 2015, doesn't seem like that long ago, only 9 years ago. That was largely just a function of history, sort of coincidence of history, that two blocks down the road from the business school where we were was the computer science department at the University of Toronto, where Professor Jeff Hinton did some of the pioneering work on deep learning. And so we had some of the first graduate students that were applying deep learning to applications in healthcare and life sciences, security, and financial services. And then he was appointed Governor of the Bank of Canada right when COVID arrived. So his formal appointment began, I think it was in June or July of 2020. And so he has been there since, during that very unique time in modern economic history, while we dealt with COVID, and then, of course, the aftermath of COVID that we're still managing today in terms of all of the inflation management that's happening around the world. So, Tiff, it's wonderful to welcome you back. Thanks for joining us.
Well, thanks, Jay. It's great to be working with you again for at least the next 45 minutes or so. And thank you for inviting me to this NBR conference on the economics of AI. It is great to see so many of my former colleagues from the University of Toronto. I will admit, the economic implications of AI, it is a bit of a daunting topic. And I've learned a lot from you and from your colleagues. So I'm particularly looking forward to our discussion, and hopefully there can be a bit of back and forth. I am going to start with some opening remarks. I do want to say a few words about the economic implications of AI, and particularly what are the implications for a central bank. Around the world, digitalization is pulling our economies in new directions, and artificial intelligence, and particularly its newest offspring, Gen AI, is accelerating that pull. It is still early days, but we're already seeing AI is disrupting existing industries and creating new ones. How AI will affect the global economy, and indeed humanity, is on all our minds. It's easy to find enthusiasts who say AI is going to take us to the land of plenty. It's also easy to find doomsayers who say we're headed for a bleak future with a few big winners and many losers. I would be wary of anyone who claims to know where AI will take us. There's just too much uncertainty to be confident. We don't know how quickly AI is going to continue to advance, And we don't know the timing and the extent of its economic and social impacts. But that doesn't mean we can't gain insights into what could happen. The past is still a useful starting point, the laws of economics still matter, and people still respond to incentives. And that includes prices. As central bankers, we care a lot about prices. Our mandate is to keep price inflation low and stable. So what does the latest wave of AI and more broadly ongoing digitalization mean for what we do at the Bank of Canada? I'd suggest there are two broad elements. First, we need to better understand how AI will affect workers, consumers, the economy, and inflation. And second, we need to use AI ourselves to best deliver on our mandate for Canadians. So in my remarks this morning, I'm going to focus mostly on how AI could impact the economy through productivity, through employment, and through price-setting behavior. Then I'm going to discuss a few of the implications for monetary policy, and finally, I'll say a few words about how we're using AI at the Bank of Canada. How we apply our monetary policy tools depends on our assessment of broad price pressures in the economy and where we think inflation is headed. And a key input is our estimate of the economy's maximum non-inflationary growth rate. We call this potential. Potential growth depends on the supply of labor and the productivity of that labor. AI is expected to mainly impact labor productivity. When labor productivity is rising, the economy can grow more quickly without causing inflation. So the question we need to tackle seems simple enough. How and when will AI affect labor productivity? AI has all the hallmarks of a general purpose technology, or GPT, meaning a technology that can have significant and wide-ranging effects on an entire economy. But how large and how wide-ranging is very hard to predict, and forecasting the timing is no easier. We know from history that it takes years for GPT to diffuse through the economy. We also know that the first applications are typically less transformative than the new businesses and new business models that eventually emerge. This all suggests we won't see the full effects of this wave of AI anytime soon. Nevertheless, we are seeing encouraging early results from firm-level studies on AI. In one study, German companies that used AI were found to be more productive. In another, consultants at a global consulting firm were on average able to produce better work and do that work faster using AI. A third study found AI helped call center employees be more efficient by sharing best practices. And some of the biggest gains can be seen in coding, where Gen AI has half the time needed to complete some coding tasks. Still, these studies can't tell us how AI will affect the broader economy. To understand that, we need to consider the productivity effect across all major sectors. One estimate is that AI could automate 25% of all work tasks in the United States and boost total factor productivity, or TFP, by 9% over the next decade. A similar sustained improvement in TFP in Canada would raise average income per person by roughly $4,000 a year. This productivity boost is not just from automating tasks. As workers in lower productivity jobs are replaced by AI, they're freed up to fill more productive jobs in the economy, and new products and new services emerge. These latter two effects provide most of the positive impact on productivity. However, more pessimistic estimates suggest that AI might have only a modest impact on productivity. These assessments take the view that fewer tasks can be effectively automated. AI could also create negative outcomes, such as amplifying internet addiction and enabling malicious actors. These adverse effects could substantially decrease the net positive impact of AI. As we look at the effects of AI on the broader economy, we also need to ask if this technology will be transformative enough to significantly boost productivity growth. Or will AI simply be the latest innovation in a chain of innovations like the sewing machine, evolution of telecommunications, that have kept productivity growth rising at its historical pace? This matters a lot because productivity growth plays a key role in determining how fast the economy can grow without sparking inflation. So what is actually happening? The infrastructure needed to make AI broadly available is being built quickly. AI platforms are sprouting up, and it's getting easier for businesses, both large and small, to access the technology. But we're still looking for the new products and services and the new business models that will transform efficiency and productivity. AI adoption and its full effects on productivity will play out over many years. In the long run, we can expect AI to boost productivity. Higher productivity allows for higher wages, more spending, without pushing up inflation. But what about the short run? Already strong investment in AI technologies is boosting demand in the economy. The run-up in equity prices is supporting consumption, as is the boom in the hiring for workers with AI and related skills. Electricity demand is also surging as new data centers are built to accommodate the enormous computing requirements of AI. This all suggests that in the short run, AI could boost demand more than it adds to supply through faster productivity growth. And if that happens, AI adoption may add to inflationary pressures in the near term. One of the biggest questions is whether AI will be something that helps people do their jobs better, or whether it simply replaces jobs. There's a lot of talk and some good research on this issue. Studies suggest that a significant share of all job-related tasks could be done by AI in the next few decades. Over the very long run, machines could be doing a lot of the tasks people do now. Does this mean we're doomed to a surge in long-run unemployment? Economic history offers us many lessons on the effects of technological change. Over the last 200 years, the displacement effects, or the jobs lost due to changes in technology, have been outweighed by the countervailing effects, or the increases in labor demand arising from these innovations. This includes jobs that are created because of increased capital investment, the advent of new goods and services, and greater demand for tasks that can't be automated. To put it another way, from the mechanization of agriculture to the emergence of the assembly line to the introduction of computing and the internet, technological change has ultimately been a net positive for overall employment. But some argue this time could be different. In an AI-dominated world, the displacement effects could be bigger and the countervailing effects more muted. AI could shrink the number of non-automated tasks so much that there isn't enough work left for the displaced workers. And if many of the new goods and services are created by the AI itself, the labor market may not benefit from the increased demand. In addition, in past change cycles, technology was diffused over a prolonged period, so labor had time to adjust. But this time, the adoption could happen much faster, creating more disruption and a loss of livelihoods that will be difficult to replace. So far, we don't have much evidence that labor is being displaced by AI at rates that would lead to declines in total employment. If anything, digitalization and the commercialization of AI have likely been a net job creator in Canada. Employment in computer systems and design and related services, which is a proxy for digitalization, has risen 48% since the end of 2019, compared with a 6% increase in employment in the rest of the economy. This recent growth builds on an existing trend. While overall employment is up 17% over the past decade, employment in digitalization-related segments has more than doubled. But we know there are probably more profound effects to come. As AI becomes more established in the economy and its impacts more transformative, it could end up destroying more jobs than it creates. And the people who lose their work to automation may struggle to find new opportunities. This is a concern for all of us. Understanding and shaping the labor market impacts will be increasingly important as AI continues to advance and diffuse through our economies. In addition to productivity in the labor market, AI may also affect how businesses set prices. There is already evidence that digitally intensive firms change prices more frequently. For us central bankers, this means the Phillips curve might be steeper than previously thought. When combined with a more shock-prone world, this suggests that inflation could be more volatile than it was in the 25 years leading up to the pandemic. AI could also affect the level of competition in the economy, though its impact is ambiguous. Initially, AI-intensive startups could seize market share by undercutting incumbents. This would increase competition and lower prices. However, AI could also result in a market dominated by a handful of companies with monopoly power. In this scenario, AI would ultimately lead to less competition and higher prices. The monopoly effects are easy to imagine, with several superstar firms already dominating their sectors. Fortunately, we do have competition authorities to deal with undue market power, but these authorities will need to keep pace. All this means central banks need to be closely attuned to how AI will affect inflation, both indirectly through overall demand and supply, and directly through price-setting behavior. So what does this all mean for central banks? We know that AI could have profound effects on the economy, but we also know that the timing, the magnitude, and even the direction of these effects is uncertain. So how do monetary policy makers manage this uncertainty? When you enter a dark room, you don't go charging in. You cautiously feel your way around, and you try and find the light switch. That's what we're doing. What we central banks need is more light. This means better information along with research and analysis on how technology is diffused, its impact on businesses and on workers, and its effect on the overall economy and inflation. And to this end, I encourage academics to work with businesses and policymakers to better understand and predict the impacts of AI. And I applaud the National Bureau of Economic Research and my former colleagues at the University of Toronto for this conference series, which is putting a spotlight on the economics of AI. We can also use scenarios to better understand the potential effects of AI and manage the risks so we get more of the good and less of the bad. For example, in a recent speech, Geeta Gopinath, Deputy Managing Director of the IMF, explored how the adoption of AI could worsen the next recession for workers. She noted that in previous downturns, most automation-related job losses happened in the first year of the recession, and those jobs never came back. Widespread adoption of AI could make this problem worse because more jobs could be ripe for automation. AI adoption could also lead to financial stability issues. Banks and financial institutions are investing in AI to improve customer service, to enhance compliance and risk management, and to better assess credit and liquidity risks. In principle, these investments should improve efficiency and stability. But there are pitfalls. Operational risks could become concentrated in a few third-party service providers, and an event at one could quickly spread through the entire financial system. The predictability of AI can deteriorate unexpectedly, suffer from hallucinations, or be biased and discriminatory. And AI makes everything move faster, which could amplify severe market runs and herding behavior in times of market volatility. Scenarios help us ask tough questions about how monetary and financial policies should respond to the risks we are facing. And they also help us be proactive in protecting our economies and our financial systems. Finally, let me say a few words about how we're using AI at central banks. AI is not just for startups and tech giants. Many central banks are already using AI as they strive to deliver on their mandates. At the Bank of Canada, we use AI to forecast inflation, economic activity, and the demand for banknotes. We use it to track sentiment in key sectors of the economy. We use it to clean and verify regulatory data and to improve efficiency and de-risk our operations. But I think it's fair to say we've only begun to explore this technology. With very large and highly disaggregated data sets now available, there is huge potential to use AI to better understand how consumers and businesses are behaving. and how businesses are setting prices. To take a full advantage of the potential of AI, we need to invest in data and computing power. We also need to ensure that we have staff with the skills that will make the most of this investment. And we're going to need to leverage outside expertise. And that's why we're so excited to be part of the new Toronto Innovation Centre run by the Bank for International Settlements. The Innovation Centre is designed to encourage collaboration among academics, the private sector, and central banks to explore the latest technologies. As we deploy AI, we also need to consider ethical implications. It's not always easy to strike the right balance between moving forward and fostering innovation and taking the time and care to be responsible and secure. At the Bank of Canada, we have principles that guide our use of AI. For example, we need to be transparent when we're using AI for a task, and we need to have safeguards in place to ensure we are appropriately skeptical when we use AI to generate content or analysis. It's time for me to wrap up. The recent advances in AI, and Gen AI in particular, have the potential to transform economies around the world. However, a lot of uncertainty remains. We all need more light. We need academics and businesses to work together and examine how technology is diffused through the economy. And we need to better understand how AI will affect productivity, employment, price-setting behavior, and inflation. This work's going to take some time. And in the interim, we should use increasingly informed scenarios to help manage our uncertainty. We are still in the early days of what could be a transformative technological shift. We don't know yet what will come, but we can shape the future path. For central banks, that means maintaining price and financial stability in the face of disruptive technological change. And it means leveraging AI to do our jobs better. Thank you very much. And I'm just going to grab.
All right. Thanks very much, Tiff. And so we've got a little time now for questions. I'll start off with a couple, and then if you have a question for Tiff, then just raise your hand. So, Tiff, thank you for that. And let's start with a question on just, you mentioned increasing the speed of price changes. And we'll focus right now on supply chain. So, I was recently speaking with a large consulting firm, one of the largest in the US, that does procurement consulting. And so what they do is they work with Fortune 100 companies, and they help them identify where they can significantly reduce costs in their supply chain. And so the way they do that is they look at their existing vendor contracts, and they'll identify one or two or three where conditions have changed in that market. There's either been a significant increase in supply or a drop in demand, and they think that there's price softening, and they could go back and renegotiate and maybe take out $50 million, $100 million of costs in terms of renegotiating with a vendor. Now they've deployed an AI solution. So rather than sending a team of people that will spend a year and identify 3 or 4 vendors, they go through thousands and thousands of vendor contracts and identify hundreds of renegotiation opportunities, and have automated a significant fraction of that workload so they can do many more renegotiations. You would imagine that could lead to significant increase in the speed of these types of price changes. How do you anticipate that entering your data flow to impact the process that you use for monetary policy?
Well, a couple things on supply chains. First of all, for better or for worse, we've had to learn a lot about supply chains in the last couple of years. And a couple things we learned. Supply chains, they're very complicated, and they can interact in very unexpected ways. The other thing that became evident was that what is individually in the best interest of each business may have some unfortunate macroeconomic effects. So when a business starts to see that they're having trouble getting certain key components for their manufacturing process, well, what do? They try to find some more suppliers. They try to build up some extra inventory. They try to stockpile it. Well, of course, that makes the shortage worse and has a macroeconomic effect. So we're not actually using AI to do this, but we have invested a lot in trying to understand supply chains, get more granular data, and in our macro models, our next generation, we're trying to build more of the input-output structure in there. So these are some of the foundational elements we're going to need to start to address the kind of issues you raised. And yes, I mean, I think broadly speaking, AI could make price setting more sensitive to current economic conditions. We're already, as I mentioned in my remarks, we're already seeing digital-oriented firms change prices more rapidly, more frequently than other prices. And in economics, there's a large literature about the costs of changing prices, and we often, we kind of model this as some sort of cost of going around and physically changing the price, but that's not really the cost. It's the cost if somebody has to take that decision. Somebody has to work out, well, if you're going to change the price, how much should we change it? And for businesses, they may face a trade-off. If they change prices too much, they may annoy their customers, and their customers may go somewhere else. On the other hand, if they don't change prices, they could be leaving money on the table. So to the extent that AI allows that to be automated, the cost of thinking through that goes down. And so, yes, you could see more adjustments in prices. Where the other element is, we think we may be in a more shock-prone world than we've been in the last 30 years. And I think this group can identify a few reasons for that. So, but if you combine basically a steeper Phillips curve with a more shock-prone world, we could see more volatility and inflation. That will make our job harder, because what we really want to focus on is not the short-term ups and downs in inflation, but where's inflation headed? Monetary policy works with a lag. We have to try to see through short-run fluctuations and focus on the trend.
Okay, let me pick up on the shock, and then we'll take questions if there are any. With regards to, can you imagine any scenario where you would increase the frequency with which you have make rate decisions?
Feels like the frequency's been pretty high in the last few years. So I'm actually kind of hoping that we get to a world that is more stable.
Well, I don't mean rate changes. In other words, there's, I think, a consistent frequency of decisions, and often the decision is no change.
Right. Well, look, I think, and this is kind of a broad comment on policy. If the world moves faster, policymakers are going to have to keep up. We're going to have to move faster. Now, exactly what that means in terms of each decision, that's hard to say. But yes, I think we need to keep up with the pace that things are moving at. And yes, AI, whether it's in the financial system, whether it's in price setting behavior, it has the potential for things to move faster.
Okay. Yes, please, Jason. Mike here, please.
Jason Furman. So I wanted to understand if this is going to change at all how you do your updating in your forecasts. So in the mid to late 1990s, there had been like a year or two of faster productivity growth, and Alan Greenspan decided that it was going to continue, even though statistically that was an incredibly thin basis for it, but he was looking at things other than just data out there. Given the possibility that there might be a structural break, and we don't know whether there is or isn't, does that mean you'd maybe shorten the amount of time you'd need to update your views of potential if you see some changes, or would you continue to do what economists usually do, which is treat these data as pretty volatile and update slowly? So will it change how you update?
I mean, I think there's no simple answer to that, but I think what it means is that we will continue to look at things from a very macro perspective, looking at trends. But you're right. If you only look at it that way and the trend shifts, for sure you're going to be late in identifying that. So you're going to have to complement that with really looking much more on the ground. What is happening at the firm level? How many firms is this happening at? Right now, mostly what you see is, yes, companies are using AI, but most companies are not using it for really high consequence things. They're starting with lower risk things, not transformative revenue generating things. I'm not saying there aren't businesses that aren't doing that. Clearly there are, but if you look across the economy on average, if that starts to change, you would have to start to think, well, okay, maybe we can't see this in the macro trend yet, but something is happening. And from a risk management point of view, yes, you'd start to take that into account.
Yes, please, Pedro.
I'd say, we're not seeing that yet, especially in Canada. Productivity growth has been weak.
So when you look at the more advanced users of AI, the Googles, Metas, Amazons, what they're doing is that at this point, and they've been for a while, is that on a day-to-day basis, the business is run by AI. There's all this data coming in, and there are all the decisions being made at the level of individual customers, et cetera. And then what the people there do is they kind of steer the ship. Do you see the same thing happening with things like policy making, rate setting, and whatnot? Should it happen? How will it happen?
Well, let me say a couple of things. First of all, models are an important input into monetary policy, but two things. They're not the only input. We use models to help us see where the economy is going. We use models to help understand what's happening in the economy. But we also use all sorts of other types of evidence. We have a lot of surveys of businesses, surveys of households, for example. The second thing is models in the policy world, in monetary policy, they don't take decisions. Decisions are taken by monetary policy committees. These are people that bring a diversity of expertise. We look at a diversity of inputs. And I don't see that changing anytime soon. The other thing I would say is that there are some features of AI in its current form that limits its usefulness for policy analysis. And these are well-known problems. People are working on them, and they may well be overcome. But two I would highlight is, first of all, as you know well, AI models are dynamic. They're always updating. And so from a policy perspective, that means if you have a model and you put the same shocks in and you have the same starting point, you might get a different answer than you got a year ago. That's a little unnerving. Now, yes, I mean, the model's improving, so that's a good thing. And of course, we do update our own models, but we do it manually, and we consider, okay, well, this has changed. What are the implications of that change? Are we comfortable with that? The other element of AI is that it lacks explainability. And as I was just saying, yes, we use models to forecast the future, but a lot of what we use models for is just trying to understand how the economy is working. How does one thing affect another thing and then loop back? How does sort of individual behavior add up to a macroeconomic effect? How do expectations affect current decisions? So, right now, AI, it may give very good predictions, but until the AI can actually explain what are the channels, what is the causation going on, what are the partial equilibrium effects, what are the general equilibrium effects, until it can do that, it's harder for us to use for policy analysis. So, as I said, I know these are well-known problems. People are working on them. I think when we get there, these models will be more useful for policy analysis.
Just before we go to the next question, if you can return the mic to Pedro. Pedro, can you answer your own question? In other words, because I know you've thought about this. So how long, in your view, until we have some country with a central bank, with a small number of humans and an army of AI agents, that are going through these processes?
I think not very long, and in fact, you already see some of that happening in some. Usually, some banks are ahead of others, and sometimes, maybe ironically, smaller countries take more risks, or there's just more of them, so it's more likely to happen. I mean, I was listening to Tiff, and I was thinking, like, this is all true, but the thing is, like, think of everything you just described, and as AI gets better, will it be able to do some of this in lieu of the humans better? And for example, there's many kinds of explainable AI today, right? It's not just, it's not all LLMs or deep, dark neural networks. So, I mean, I agree with you. There are a lot of, important problems to solve, but I think, I remember, for example, when Amazon decided to stop using people for a lot of things because they did the tests and the people for all their expertise were getting completely outclassed by the models. So, and you're right, like this thing that the models keep changing is unnerving. And often, like, it really unsettles you. It's like, you're not telling me something different. But some of that is problematic and needs to be fixed. The models are needlessly unstable. But some of them is like, well, at the end of the day, if you get better results, we just get used to working like that, right? And in many ways, the previous things that we experts thought we knew, they were just, the problem is that, we were living in a world where things seemed more certain than they really are. So maybe that unsettling effect is actually good. I think we are, right? And in fact, so this is a reference to this, satire that I wrote called 2040, where a robot runs for president. And one of the arguments there, sorry to say this, is that, like, hey, like, this is in 2040. So, with that caveat, is that the Fed is already run by an AI, so why not the country?
All right. Yes, please.
Hi. Tim O'Reilly. I loved your analogy of that you don't run into a dark room, you feel around for the light switch. And when you talked about what you meant by that, you were talking about economic research. But are there things that you would like from the AI companies that would give us more light, in the form of disclosures? It seems to me that a lot of our understanding of markets comes from mandated financial disclosures by firms. And as these firms have new kinds of metrics that they are using to manage their systems, which are not just purely dollars and cents, what should we be requiring of firms in the way of disclosures?
That's a good question. I'll admit it's not something I've thought a lot about. What I really was getting at there is a lot of the expertise is in businesses. A lot of the best AI research is not in universities anymore, it's in businesses. That's where a lot of the resources are. And I think this only reinforces the need for businesses to work with academics, to work with policymakers, to share where things are going, how things are developing. If everything is kept in a very tight proprietary world, when it used to happen in academia, there were conferences, there was regular conversations with policymakers. It's really important that continues. I think it means, academics need to talk more with businesses, businesses need to talk more with academics, and you all need to talk more with policymakers. So, specific disclosures may be part of that, but I think, there needs to be a spirit that, this is a tremendously transformative technology. We need to use it to benefit society, and we've all got a responsibility to shape it in that direction.
That is a great question. When you think about, mentioned earlier about COVID, and that was another dark room and running into a dark room. And what was the data that, in retrospect, what's the data that we wish we had, whether it's from WHO or CDC or, municipal, regional healthcare centers, in order to make better decisions faster? What are the unique data flows that we haven't asked for before? Like, in other words, if you think this is coming as fast as some people think it's coming, like if you had NVIDIA's order book, in other words, before it turns into revenue, and so you have a sense of what the demand is there before it shows up, and you had, same thing on long-term energy contracts, and the types of things that give you higher predictive capacity of what's coming down the pipe. You could imagine that might be more there might be higher returns to that early information in a period of high uncertainty than there normally is. There was another hand. Yes, please. Oh, Dan. Yeah, sure. We'll go Dan, and then we've time for just two questions.
Thanks, Tiff, for taking the time out to be here. This is a lot of things that you talked about. You're necessarily reactive to in a good way. The algorithmic pricing speeding up, leading to a steepening of the Phillips curve. Well, you don't want to be telling Amazon how to price. Concentration leading to higher prices. Well, you don't want to be having a third mandate bank in which now you have to deal with competition policy. So necessarily there's reactive, but I'm wondering, there's a large part of what you do where there's a lot of uncertainty about how things actually work. Like you change the policy rate. When we teach our students, we teach with certainty how does that policy rate actually affect banking down through to consumers and businesses. But we actually have a lot of uncertainty about the nitty-gritty of how that works. I wonder if there's scope for the micro experiments between where we coordinate the bank's behavior, perhaps with some major actors within the Canadian financial sector, be it a bank, a credit rating agency, whoever. Is there ways of just doing these little experiments that, say, Amazon does all the time, for you to do in a way that is really has almost no, it affects so few consumers in the big picture that it goes unnoticed by the financial system?
Well, I'll confess, is running experiments isn't something we've thought about. We do use things like behavioral labs in a lab setting to look at how you can run experiments where you give people certain situations and see how they react. But that's not doing it in the real world. That's doing it in the safety of a lab. Where I think, getting to what you were pointing out, yes, there is a lot of uncertainty in exactly how the monetary transmission policy works. We also know that how quickly it works, how it works, depends a lot on the starting point. What is the situation people find themselves in? How indebted are people, for example? These things all matter. Where I think there is a lot of potential for AI is, we now have very large data sets. So, for example, if you have your mortgage at a federally regulated financial institution, we have that mortgage at the Bank of Canada. We don't know your name, it's all anonymized, but we have all those mortgages. So we can see how mortgages are resetting, we can see the terms, we can see, and we also now have the raw data that goes into creating the CPI. So the millions of price observations. So, in both these things, we can, and we're not, we are using these data sets. We have not used AI. We've been using more traditional methods. But I do think there is potential to really trying to sort of look under the hood and see how, for example, the monetary transmission mechanisms works. And, the reality is people are in very different situations. It's going to work differently for different people. And we have the potential to understand that much better. Similarly, for pricing behavior, your first question, firms that are more digital using AI, we may see prices become more sensitive to current conditions. Other firms, they may not do that. So, the combination of these new very large data, being able to get these very large data sets with AI does open up possibilities to start understanding what's going on under the hood much better.
It's all right. So I'm sorry, I know there's several more hands up. We're out of time. So Tiff, let me just thank you. Thanks very much. We really appreciate it.
Pleasure. Thanks for inviting me.